Good afternoon and welcome to my webinar on some good housing news. I'm Kathy Fettke, co-founder and co-CEO of Real Wealth Network. And I don't know about you, but I'm super tired of negative news. So I did some digging around to brighten your day and give you some positive news. So let's go through it and see what I found. And first of all, I just want to make sure that you understand this is my opinion only. So take the data and interpret it as you like and what works best for you. And if you do purchase property, which many people are, in fact, at Real Wealth, that we're shocked that we've had two of the best months I don't know if ever, but two of our strongest months of of property sales in March and April. So that was very, very surprising. But it is true. So I think a lot of people are finding safety in real estate for their investments. But if you were to buy any property anywhere, always make sure you get a full home inspection. We see a lot of people failing to take that step, and that is one of the most important steps to protect yourself. Even if I were buying a house next door, I'd want to get lots of inspections to make sure that it's in the condition that I'm expecting. And also the same for ordering an appraisal to make sure it's the value that you are expecting as well. A lot of people pay cash, and then skip the step of getting an appraisal, but don't do that. Getting a third party is so, so important. And of course, requesting a seller's property disclosure statement and always going through title and escrow. I mean, whenever I see these fraudulent things going on, it's because people missed these steps. So you can really protect yourself in real estate if you just follow the checklist. And if you don't have that checklist, you can download one on our website at Real Wealth. So I don't really have to go too much into this because there's plenty of bad news, but we'll just take a look that we do have a lot of cases in the U.S. and a lot of deaths, of course, and very, very sorry for anyone affected by that. And I know it's starting to get real for a lot of people. I know personally some people have been affected, so my heart goes out to those who are or have been sick or still battling it, and of course our healthcare workers and all the people losing their jobs. We know that we got another jobs report today, and now the Fed is estimating potentially to unprecedented unemployment rates here. GDP contracting to 4.8% in the first quarter. That's the first negative growth rate since 2014, and it certainly wasn't that big back then. So just headline news everywhere that's terrifying, and people don't know what's coming next. So I thought I would just show some data that might make you feel a little bit better. So again, we see lots of confusing news too, because sometimes in the same statement, it'll be job losses, but then you'll see the Dow Jones is up, and how can that be? So again, it's confusing. I have been asked to be on a lot of news shows over the years, after the past 10 years, and I'll tell you what, a lot of times it is with a very negative headline. And I'll usually show up and be shocked that I'm being asked a question that I just didn't expect. Like you can see there in the second picture, the big sign, housing slump, and there really wasn't one. There was a tiny slowdown in growth of price gains, which was actually a good thing. I think that was about a year and a half ago. It was actually a good thing. Appreciation rates were slowing down a little bit, so it was making it a little bit more affordable. But instead, the headline was housing slump. So I had to explain that. When I was on Neil Cavuto's show, it was kind of the same thing. Are these higher interest rates going to slow down housing? And yes, they were. That was the whole point. The Fed was raising rates to slow down the fast appreciation of real estate because it was becoming so unaffordable. That wasn't necessarily negative news. It was just depends on which side of the fence you sit. If you're a buyer, that's great news that that prices would maybe slow down, or price gains, I should say. And then for anyone who hasn't seen my interview with Robert Schiller, that's on our website at Real Wealth, and that was back in, I believe it was 2013, and I was asked to debate Robert Schiller, which was terrifying. He's a Nobel Prize winner in economics, and just got a San Francisco State University. He's got the Yale degree, so that was scary. But we do have a huge network. We're connected with people all across the country who are real-time boots on the street doing real estate. So I felt like from that perspective, I could take him on. And I feel like I did, because he was saying at that time it was a dangerous time to buy real estate. And if you looked at the data, sure, it looked terrifying. Home prices had been in decline for 4 years, so it was scary. But if you really looked ahead, and you looked at the fundamentals, you could buy property for so cheap, rent it out for much, much more, sometimes 3 times more than the mortgage payment, and cash flow, knowing that you are buying an asset for much, much cheaper than it costs to build it, much, much cheaper than replacement value. So it just didn't seem risky to me. Plus, you could lock in historically low interest rates for 3 decades, lock in that payment while knowing rents will go up, and they certainly have. So bottom line is, headlines are meant to scare you. I've been in media my whole life. I got my degree in broadcast communications at San Francisco State. I worked in the newsrooms of CNN and Fox and ABC News in San Francisco. And hey, if it bleeds, it leads. There's one way to get eyeballs, and the way that humans are trained is, over the years of having to survive, for, just to survive, we're always looking at what's going to kill us or eat us. And the media knows that. And if you'll watch the news, they can sell advertising. It's good for business. And the way they're going to get your attention is to scare you. And that's really important to understand. So just look at every headline carefully, dive in deeper, do your research. And, if you see a study, don't just take the reporter's opinion on it. Look at the study, look deeper to find out if there's some kind of an agenda. And there's always an agenda. We have an agenda. When I see headline news that fewer people can afford to buy property, well, if you're a home buyer, that's bad news. If you're a landlord, maybe it's good news. More people are renting. So it just depends on your agenda, and everybody's got one. So you've got to be clear about what your agenda is so that you can interpret the news in a way that supports what you're trying to do. And you got to understand what their agenda is and why they're reporting it in the way that they are. So I think a lot of people saw this. Look at all the stories that came out on April 11th or at the beginning of April saying a third of Americans didn't pay their rent this month, and 31% can't pay, and just on and on. Boy, it was every single news story took this perspective. But what was it? What was the story? It basically came out that at the beginning of April, and this is the beginning, by the 5th, basically at the beginning of the month, only 80, 79% had paid. But if you dig into the article, first of all, you got to look at rental apartment vacancy rate. It was already pretty low from historic levels, and it was the beginning of the month. So when you really dive into the article, and this one is CNN, it says with nearly 10 million Americans filing for unemployment in March, April is going to be a difficult time. Now we have an idea of how difficult. Nearly a third, 13 million US renters, 31% did not pay their rent between April 1st and April 5th, according to the National Multifamily Housing Council. We all saw this. What you see at the end, if you keep reading, is while the data is concerning, it should be put into context. There are 44 million renter households. Now only 13 million were surveyed. And it was only by the 5th of the month. And I believe it says here, many offices were closed and standard operating procedures were disrupted. So bottom line, this was fake news. So when the real news came out, and look at that, National Multifamily Housing Council data collected from those 11 million apartment units, 91% paid by the end. So when you look that up, you couldn't find it. You couldn't find it. So A lot of times the headline news will come out, and when there's a retraction or when the new data comes up, it just doesn't make the same headline news because it's just not that interesting, not that interesting that people pay their rent. So if you look here, we know that the government is doing everything they can to help both landlords and renters. So you'll see the COVID-19 relief for multifamily landlords and their renters. This is unprecedented stuff here. Freddie Mac Multifamily recently announced, of course, this isn't that recent anymore, but a relief program affecting more than 27,000 multifamily apartments and more than 4 million renters who reside at those apartments. So we know that an apartment owner with a Freddie Mac multifamily loan can work with their lender to obtain up to 90 days of forbearance, and then that the renter can too. So really the government was saying, hey, we know this is a tough time. This is unprecedented. For the next 3 months, it's going to be tough, and we're going to help you out here. So that's what was happening. Now, the same question people have, and I'm sure you have, and I have had over the last few months, is how is all this going to affect the housing market? Is it doomed? Are we doomed as real estate investors? And if you search that, well, look at that. Look at these. Is the US hurtling towards another housing crash? That's terrifying. And, will the housing market crash amid COVID-19? A $1.3 trillion US housing market crash is imminent. Is it? Well, it would be, yes, if people cannot pay their mortgage. That's pretty tragic, as we could see in past recessions. This is just a list of how cities fared in past recessions. And in the best of recessions, not much happened in real estate, very unaffected. In the worst housing recession, and that is specifically the housing recession of 2008, it was real bad. It was real bad in a lot of places, and that's why people got so many bargains on real estate. That's why so many people got hurt by real estate. But what caused that recession? That housing. It was a housing recession. It was stupid loans, bad loans given to people who had no ability to pay those loans back. And that didn't work out well, did it? That was just poor financial management of everyone and anyone involved in that, between the banks and the borrowers and the brokers, and just not smart business to give somebody a loan that they're lying on. I mean, I was in the business at the time. Everybody knew what was going on. So of course that didn't end well, and that's what happened. There was a big housing recession. So a lot of people are thinking that's going to happen again. They have pain still from that time frame that was only 10 years ago, well, 12 years ago now. Also, a lot of eager people thinking, yeah, I want property in Riverside County for 60% less than I'm paying paid last month. In Atlanta, yeah, I want a 50% discount on properties. Well, remember, that was a different kind of deal. It was a different recession. It was based on years and years of bad lending that blew up, and they knew it was going to blow up. They had the dates when those loans would reset. And sure enough, when the loans reset, guess what? People couldn't pay them. It caused a big problem. But the average, if you remove the housing recession, look at that. In Atlanta, only -1%. Dallas, only -7%. And a lot of the past recessions were oil related. So you could see why Dallas would have been affected back when they were more dependent on oil. Denver, only 1%. Los Angeles, -9%. See, California markets, look at San Bernardino, Riverside, -8%. Because they go up so much during hot markets, they often come down a little more than others. But certain markets, Orlando, -2%, Phoenix, -2%. So there's markets that tend to be more stable because they just don't go up in value as much, and they don't go down in value as much when it's just a normal recession. So today, let's look at what's being affected. Is this a normal recession? There's nothing normal about this. Nothing normal at all. I mean, 2 months ago, it was headline news was housing's too expensive, it's unaffordable, there's more jobs than there are workers, job creation, I mean, on and on. Just, the stock market kept going up, and bam, suddenly everything changed nearly overnight. But is it really a normal recession. I mean, what does it mean? Well, when we look at this, at least for now, and we don't know what's coming, but at least for now, we know that there have certainly been job losses. But when we look at who lost their jobs, we kind of know what you know has been most affected. It's been travel, um, leisure, restaurants. The people who have been affected the most are really the most vulnerable to begin with. So that's tragic. And that is why there's been stimulus, not nearly enough stimulus for them. I mean, a $1,200 check isn't really going to save them, but it's going to help for a month. And especially at that price point, if you're making between $20,000 and $25,000 a month, well, I mean, not a month, a year, then it will make a difference to receive that, especially if you're a couple or you're married, and so it's $2,400, and maybe one of you loses your job, so you get to get on unemployment, and unemployment benefits are pretty great right now, if you can get them. But again, at that price point, maybe they have roommates, maybe they're there's renting a room, or they're married, so there's two people in that house, or they're probably not necessarily homeowners. They're probably renters. So this would affect more the people who rent, right? And that could affect landlords if their tenants can't pay the rent. So that might mean, maybe lower income housing as well. But when you look at over $70,000 in income, there's way less affected, way less affected. Again, that's so far. Anything can change. Anything can change. And so if there's one thing we've learned, anything can change on a dime. But at least so far, that's what we're seeing.